What's up, everybody? Let's go. Yo, good morning. Market's opening irrational. Already out the door. Small, light. Positioning. If we do anything at all, I'm likely going to sit down and do absolutely nothing. So I'm pretty much able to wake up, see that, know the market's going to be something to avoid, and then just call it a day. You know how that works, right? 5 rules, irrational market rules, DD bans are the ones that triggered. This is the way we operate here. You can wake up at the beginning of the day and know that this is a day you want to avoid, if anything. I mean, you can try to do something, but I don't. Do whatever you want. I'll tell you. Nothing better than waking up, feeling empowered, and saying, man, I'm going to take the day off today. Get some work done, some real work. I have a platform to make. Do I need to waste my day gambling for something small, something light? Make better use of my time. Y'all can all do the same. Wake up, have an idea, treat it that way. Let me get you the video really quick that talks about the 5 irrational market rules. They will all be eventually programmed in the platform, which is the best part. You guys will wake up. Platform will say, Rock Scooter deems this market irrational, and you can have an option to turn it on, and it turns off the indicators that we don't use when irrational. Morning, and morning. What is an? I hear an ad in the background. Oh, there it is. An ad for that video. All right, watch that video. If you have any questions, also part of your training, 4-week training. Right out the door. Let's talk. Out the door. So it's gonna open right on the edge, right? So it's there. But usually when you crash through and tap it in the overnight session, we had overnight selling. You know, we all had that BOJ decision way back when. It's called just additional market selling. You can tell exactly which indices were selling off. This took place after 2 o'clock in the morning. We're talking about, we got the FTSE index being keeled overnight. So our market's trading lower at the bottom of the DD band. Now the market will fight rational, irrational, rational, irrational above and below these bands. If you write these numbers down, you will see these as high volume pivots all day. 39, 16. Mike volume's very low. There we go. There we go. Sorry about that. Rational market. We touched the lower band. So I posted the video. 39, 75. I'm leaving the decimals out because I'm being lazy. 11, 373. 2. These are DD band numbers. So in the Rocket Scooter prime calculations, 11, 5, 91. We're going to wake up likely with a shift in that ratio. It's probably still going to be close to the upper. It was, I think last time when we looked at, where is my platform? Let's close it all down. Today, we're going to have a Rocket Scooter Education Day. Teach you guys how to use the platform. Teach you guys some of the features and new features coming up. Redistribution zone will be programmed on the charts. I thought they were going to release it today. It's probably going to be tomorrow. So all you scalpers out there, index scalpers that love that redistribution zone scalping trick. One risk interval travel is on. It looks like it is, sir. Let's take a look really quick. Again, I'm using my conversion really quick. Let's convert them to And the Google Sheets tool here. Go to Sheets. Let's go. I had a Google Sheet that I used for this, and I don't know what it is. Let me make it one. We're racing the clock here. Time to start. 39.16. 39.75. Actually, I can demonstrate how to do this. Everybody live. Okay. So I already have green lines that I drew on here. Let's move them over here. Let's get SPY going. And these lines over here. And what you do is you make a ratio of the current SPY price. Usually you write at pre-market, write a market, you know, anytime pre-market. It's pretty much similar. So right now, let's see where SPY is currently trading. You're talking like my Discord over here. Where's my Thinkorswim charts? Let's put those over to the side as well. Get over there. Okay, so we have my, obviously we're above February triple B. We'll talk about this today. That's a whole other thing. We'll just say, let's just pick a number. Like right now, the SPY is trading at, or S&P is trading at, you know, 39.1925. And at the same time, just, you know, put SPY together. You want to find a ratio of the two. And we will say that right now we are trading at 39.89.11 is like the last price, right? We're going to do a, well, 39.89.19, just like that, right? And you'll reference the same 39.21.75. And you'll do a ratio, right? 389.19. So you take the two numbers and divide them by each other. Very simple. And SPY is easy because it's usually 10. We do this for all the things, 10-ish. And then you take that ratio, you take those DD numbers and divide it by that ratio. Very simple. And then you can just manually put it on here. These should be on the chart. We actually called our data providers yesterday, a new data provider, and futures data, ladies and gentlemen, is on its way. We started that process officially yesterday. Futures data, not only futures data, but futures trading. The rocket scooter. 2 months or less will be here. Let's hype. Hype, hype, hype. Click that like button. Trading through our platform. Bank it. You like that? It is coming. All right, let's convert the numbers. We have 39.16, 39.75 time divided by that ratio. Simple. And this is an educational day because the market is irrational. So there's no reason to really go too heavy on this. So I'm going to take these numbers. I'm going to draw manual doomsday bands. I'm just give you all the numbers. I'm going to cheat. Y'all just get them from me. Hey, what's up? Can you guys hear me? Check, check. Check, 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 check. 39. 388. 61. Hold on. Did I do that right? All right. Let's go. Let's go. 39.16 becomes 388. I'm gonna take the green lines. I want you guys to just mark it what you like. This irrational day. So today out the door, I want y'all to just do exactly what I'm doing right now. I'll mark these two green lines on your chart. Here's the levels: 388.62. If somebody wants to write them in so that everyone else can see it while I'm drawing them. 388.62. Watch my screen. 394.47. You will. This lesson will be the lesson that saves your ass more often than it doesn't. 394.47. This is a sit out day from the start. From the start of the day. And I'm going to tell you how I know that in just a moment. Hit the like button. We'll go there. The best trading stream on the planet. It's probably out there. We're all right, though. If you guys want to stick around and learn something. If you find the best trading stream on the planet, let me know. I'd love to watch it. Okay, these are the numbers. This is your DD bands. Refresh the platform. Let's go. Ben Fisher at the win. Love you, bro. Let's go. My friend. Okay, so this is irrational. This is okay. All right, we're getting there. We're getting somewhere. Let's go ahead and do QQQ really quick. And remember, the rule is on the indices, you are, stop auto scaling. You're going to watch both. So ready, watch this. I'm going to pull out a second instance of rockets here. I'm going to click this arrow at the top and a second one's going to pop out. And we just want another chart. So let's close down all the other stuff, right? When it comes to irrational and DD, and when it comes to basically every day as well, I'm going to tell you, you must put the NASDAQ and the S&P together. You must, no matter what you trade, if you are trading, I don't care if you're swing trading, day trading, I don't care. You will watch the NASDAQ and the S&P together, especially in earnings season. So far, so good. I'm going to have my NASDAQ chart off over here to the right. So let's go ahead and repeat the same exercise. You can use any price for the conversion as well, though. We teach everybody to use the exact 930 price so that y'all's numbers are the same with each other. As the SPY and the S&P futures deviate, like they go slightly, one goes higher than one goes lower, your fraction at any point in time will be slightly different. Slightly different. They are tracking each other, but tick for tick, they'll be off. So if you do it 5 seconds before someone else, you'll come off with like 0.1% of error. It's not much. So technically, later in the day, sometimes SPY and futures may be off. My fraction's 10.0766. Yours might be 10.09, 10.05, right? It'll be really small. So when we teach everyone, it's just the reference the same point in time. Theoretically, since our calculations are done at 9:30, we tell everybody to do them at 9:30. Now, as well, though, as an engineer, when no one understand an engineer's mindset there. Must have equal reference points. So if our hedge pressure is here at 9:30, then we want our conversion to be done at 9:30 as well. So that's kind of the trick. What happened yesterday? The long setup and the long target was reached. Market sold off. So ready to utilize this for the short side? Absolutely. But the thing is, F2 futures, is that the predictable part of the market, which is what we exploit, was exactly there, right? And then after the market hits your first resistance, it's called, we actually call it random. And what happens when the market's random is you just can't predict that. And trying to predict that's impossible. And I know it looks like, oh crap, I missed out on a short trade. But in all honesty, almost everybody here, again, I don't tell people what to do, but if you did not lose money yesterday on that sell-off and you avoided it, throw me some hands up in chat and tell me, yes, you can use this platform for that sell-off. Doesn't matter if you use it. You can use it for the short side if you're shorting, but if you didn't sell, you didn't short, and you avoided it, that's also a win of 0. So we could talk about what happened yesterday. What changed sentiment so quickly? We had a whole 2-hour lesson on it after. And I'll tell you exactly what happened. I can revisit what happened yesterday if you guys would like. Let's get those DD bands really quick up on QQQ. You did short but don't have the platform. Oh, okay, cool. So we'll talk about what you can or can't do. Theoretically speaking, F2, if you want to trust what we've done, is when that target was reached, statistically, I've done a back test that shows whatever happens after buyers and sellers meet each other for the first time in any one of our calculations is that the market is completely random. So whatever your choice was to do that, technical analysis or even our analysis will produce a random result. So as what we do is we know that it's possible that anything can happen. We avoid it because it's indeterminable. So like from an engineer's mindset, it's when it's indeterminable, if I do short or do want to resist against a resistance, you can short under certain circumstances, which is the same thing as we can long. And everyone trades differently. And I'll show you the short setups today. Absolutely. Yesterday's sell-off was very, 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 very predictable. But even so, I still don't trade it because I don't trade once markets become random. because I'm losing my control. We call it like the career move and the gamble move. If you want to play the gamble move, like that big sell-off, just a small position is enough to have some fun with it, or not take a lot of risk on it. And I'll walk you guys through it. So everybody stay tuned. Hit the like button really quick while I do the calculations on Q. Let's put those DD bands up. So this is a rational market beyond these two bands, and I'm gonna do the conversions really quick. Let's see QQQ. I'm just gonna do this super quick. Yeah, so hang tight. I'll show you exactly what you want to see. You want me to find you some short setups? You trade stocks or futures? I guess futures, right? I'll show you how to do how we short. We have rules that we do short. Exactly. Or I say me. There's we in trading, but I teach rules on shorting. Absolutely. And we have the numbers are Ben Fisher. Ben, I love you. Ben already did it for me. Here I am trying to do extra work. 388. Ben, I love you so much. All right. 275.39. Let's go to market. 275.39. So one of the rules that I have is outside of these green bands, the market is completely irrational, especially if you dip underneath it overnight. The market's going to open up choppy and weird. It's a small position day if there is a position. Okay. So thank you for letting me mark those up. What we're going to do is we're going to look at the liquidity map numbers. So the first thing I do, and this is for all the new folks here. Oops, let's do SPY really quick. Is make sure you have our liquidity map open. So this comes from the Discord. There's a channel that shows this, and liquidity map will tell me where this is a 3-letter code that helps me see all of our tools at once for the most part for where buyers and sellers can be. Focus on this letter right here. It says BR, S, and U. So those are 3 different things to look for. What it's telling me is I'm looking for markets to have interactions between the 2 hedge pressures if possible. It's a bear side positioning. DD is 48. Clearly, the market has had a shift in sentiment today from yesterday. This is explaining the sell-off. That's half of the explanation of the sell-off is a rapid shift to DD from 0.8 to like 0.48. Overall, this is the percent of market cap that's bearish in the S&P. So clearly the S&P has tilted its scale to the bear side, and the SPY itself is bearish today. Okay. Doesn't mean it's going to sell off. It just means we're in bear zone. So what I'm looking for are hedge pressure pivots in the bear zone between yellow and blue, just like it shows. So there's your yellow and blue section. It doesn't mean the market's going to sell off. What I am looking for is yellow and blue pivots. You must put the 2 next to each other. There's a yellow and blue pivot, a yellow and blue pivot. So far, so good. The next thing you do is you take this number. If that number is less than half, you do a resistance from the bear zone. It's the same exercise every single day. Last thing you do is you look at resilience. If resilience is positive on the S&P, then likely so that support. However, when you breach this band, you no longer trust that, and you really no longer trust that. And we don't like to use that either. So in all honesty, in a rational day, you can't trust that your indications are going to measure what's going on as the market is irrational. Now, of all the tools we do have, resilience always is arbitrage between the S&P and the stocks. But it is a leading indicator most days when rational. Rational means you never breach the band. And when rational, most days stocks will move before the index moves. If people are buying the stocks, then the index tracks along. In irrational days, which this triggered at the start of the day, you don't know which one will move first. People can squeeze out of one or the other any given time. And with Friday being monthly expiration, which F2 futures is the explanation of yesterday's volatility, plus 2 days ago, we can predict volatility a day in advance, which today, if you watch yesterday's stream, we also predicted volatility today, which explains the overnight sell-off, didn't we, guys? The last on Tuesday, we said Tuesday's going to be mild and Wednesday's going to be unusually volatile. Check. Yesterday's stream, I showed you how I use Rocket Scooter to predict volatility today, and look at that overnight. So we're a day ahead on a lot of things, 2 days ahead on a lot of things, and breaking the DD band overnight, we forecasted unusual volatility from last night. When markets are irrational, I'm not trading whatsoever. In the trading challenge, the way I do it is I sit out completely. It's not a gambling challenge. And people ask, like, how did you go on your 70-day? By the way, 70. I'm not saying 17, 70. 3.5 months on YouTube from day 1 of the challenge. to day 70 without a single loss the last challenge. And how did I achieve a streak of that magnitude? Well, luck, clearly. But streaks are stupid, so don't think of it like that. But if you think about it, everyone will tell you I sat out a lot of days, right? I sat out. If something like this happens, I just sit out. And to go win after win, after like day 10, I was like sweating every day. I was nervous. And it was fully transparent every day. Like the account history was shown on the screen. So it was like, okay, how do you achieve that? Well, obviously, as I started getting like a little, like, it gets harder, trust me. After day 10, I was freaking out. But, and the audience grew huge. You're getting like 3,000 to 5,000 people, like views per day. It was crazy. Now, how? Well, I think 15 or so of those 70 days I sat out. I woke up today and go, no thanks. And so I didn't wrestle with a market that I knew was going to be weird. Why are drawings not kept on your chart? There's a feature you have to make sure it saves your drawings. You must save your chart layouts. You can save your indicator templates as well. Make sure that your chart is auto save is clicked on, or load all your defaults if it's behaving strangely. And look at that, irrational market. So here's the one thing. Resilience always does what resilience says it's going to do. Resilience is showing you the arbitrage between the S&P and the stocks. But the thing is, when markets are irrational, I want you guys to write this down in your lesson today. Irrational market, this is what you're going to see. That you can't tell if the SPY is selling off first or the stocks are selling off first. That's it. So rational markets, typically the stocks 90-something% of the time will always be moving first. So resilience will lead the market. You don't know if it's leading or lagging here. That's the problem. So when markets trigger that irrational signal, you have to take resilience with a grain of salt. And when it's hugging zero, you don't use it. Period. It's not long and strong. It's not short and go. It is just hugging zero and delayed. So we don't use that either. So all the signals today are off the table. I said this in the Discord 30 minutes for market open, that it's going to be choppy, weird, and a sit out day. And I'm sure people are fighting that, and I'm not. So here's how a short setup works, right? The only time I ever short anything, and any stock or anything. Now, my personal rule is I don't short individual stocks. I only short the index against this monthly hedge pressure when it opens below and trades against it. That's it. So if it breaks through it, some of our more adventurous traders like to chase that short squeeze, or is that long squeeze that happened yesterday, which exactly what happened yesterday. I don't chase shorts. I just let them fall and I lose $0. Yesterday, I lost $0. I treat it like investing, right? If I know, like, hypothetically, right, there's a nice long to resistance, and once the Nasdaq hit its resistance, it started pivoting lower. The Nasdaq started selling, right? And Nasdaq cleared a monthly hedge pressure, which squeezed the Nasdaq further. At the same time, S&P was lowering, and then it pulled S&P below its hedge pressure, which started crashing the S&P, which started crashing the Nasdaq further. You had a trigger event, trigger event, trigger event. And why did that happen? And it's very simple. It's monthly expiration and VIX monthly expiration mechanics. You have people just exercising those options they had. And what happened was, and Nasdaq, once Nasdaq buyers found some sellers, people started selling. And they just started selling just enough to trigger that squeeze. And that squeeze forces put sellers to chase the short in abundance, because those puts are now going in the money. And then all of a sudden it caused a chain reaction, which popped the S&P through its monthly hedge pressure, which also created that effect. Monthly hedge pressure is related to monthly options on the SPY and NASDAQ and QQQ. And another thing, futures, F2 futures, what you'll notice is our hedge pressure numbers, our half gap numbers, and our monthly hedge, the three lines we draw on there with numbers. These are predictable high volume pivots that will stay there all day long, and they are never wrong. Just times I don't trade them. And I say never wrong, meaning that they predict volume every single time. Doesn't mean that it has to pivot in reverse, but your pivot is there and your pivot is there. It shows where pivots are, and then it predicts the high volume that goes with the pivot. So we've isolated with two very strong techniques how to do that. Now, it's all done with equities options, but futures markets will also pivot there as well. Yeah, this is half gap right there. There's the halfway point between the equities close and open. So now you want to say, okay, markets are likely selling off. I want to find some short setups. So one of the cool things to do is to pop out the scanner. Now what I want to do is I don't need like a whole real estate. I just want to keep NASDAQ like, you know, front and center so I can keep an eye on it. Because when one of the two indices trigger, and I want everybody to know that if you're trading anything, I don't care what it is, you must, by my instruction, if you care what I'm teaching, you don't have to care about anything I'm teaching, but if you do, you must at all times watch the S&P and QQQ. I don't care what else you're trading. You must keep both of these in front of your face. Do we got it? That's correct, F2. And what half gap has to do with, and I'll tell you what's something cool, right? So some of the things we exploit has nothing to do with price action. We don't use historic price actually in any of our calculations. We don't use the shape of the price or any moving averages or technicals. We don't use any of that. Each one of our, we have 15 calculations, but for most part, we have like 1 or 2 really strong calculations for like type of traders. A futures person, you are probably trading index and other kind of futures, right? Half gap has to do with an exploit of the imbalance between the closing and the opening of the equity session. Example, SPY closed somewhere back here. Not relative to what I'm drawing on the chart, but we sold off yesterday in SPY, and then in futures, we sold off in the overnight, and now we're opening lower, right? So SPY clearly gaps down. SPY opens here, which means we close roughly here, right? Half gap, halfway point. So if the market's selling and there's a sell imbalance, right? Sell imbalance of SI at the end of the day, and this is in SPY. SPY and ES and SPX values will be roughly similar. They are so heavily traded via arbitrage, they will always track. So we get our information from SPY options to trade S&P futures. It's a trick. It's the most liquid options chain on the planet, and you get the most information about the entire stock market from SPY options. SPY options paint out risk that's also mirrored by the CFTC's commitment of traders, which is the reportable futures positions, which just shows everything ties together. So in long story short, if there's a sell imbalance, I'm gonna make up a number, 200K shares of SPY, and at the open, imagine there's a buy imbalance. I'm just gonna make up a number, right? Buy imbalance of 100K. Right, so we sell imbalance, market gaps down, buy imbalance, market starts trading up. Okay, so sellers and buyers are now in a period of, we call redistribution zone. There's sellers and buyers. I mean, if you guys know anything about market making, when there are buyers, you raise price to look for sellers, right? If there are sellers, you lower price to find buyers. And so the whole point of the half gap is exploiting this redistribution zone. And this is saying that the market makers, if there's a sell imbalance of 200, the market makers are the ones that longed against the sell, like they own a long of 200K. If there's a buy imbalance, people bought from the market makers, so they're short 100K. So the short and the long leaves a net imbalance of the two of a 100K long, right? So dealers are now pocketing 100K. They need to find people to buy from them. So as they lower price, like in this bottom part of the redistribution zone, they're going to find buyers to unload that positional imbalance to zero. And the whole goal is to take the short if it's a buy imbalance and take the long if it's a sell imbalance, and every day bring it back to zero as best as they can, right? It's just general market making. So the neat thing about half gap is the halfway point between those two because this is a discretionary choice in the equities market. Market makers will move to where they believe liquidity is, where they gap up and down, or where they close the price, right? That's the whole point. In the futures market, as you may know, the settlement price, for instance, for the S&P futures is the VWAP of the period between 3:14:30 and 3:15. That's the 15-second window. 30-second window of trading in Central Time. The VWAP of those 30 seconds equals the settlement price. They use like an equation in futures to create the settlement price that futures contract closes out at, that the CME prints at the end of the day. So futures is a whole different way of trying to close out. There's an equation that actually settles those contracts. And all futures, slightly different equation and slightly different time. But mostly it's the VWAP of the settlement window. And so that's a little different. But with equities, the market maker literally gets all those market on close orders 15 minutes before markets close. And then they know what the desire of Wall Street is at the end of the day, and they will move the price according to the final trading and then smash those final orders together at a price they choose. It's discretionary. So they choose where a liquid spot is and where a liquid spot is. So half gap is a beautiful, beautiful, beautiful pivot between in that previous instance, a sell imbalance is the market maker longs against a sell imbalance. Well, they're long right here. Conversely, if there's a buy imbalance, market makers are short there. So in the middle, right, dealers are winning from both sides of the house. And so it just shows you that there's like an equilibrium between the gap, and the half gap is clearly an equilibrium point. Easy as that. So you traders out there, the redistribution zone indication is coming out probably tomorrow or tonight. I've already played with it on the test server, and it's phenomenal. It's awesome. And so we scout between it with the rule. The rule is if the market's rational, which we lose that the minute you cross through these bands. A whole different thing that we're explaining. This is exploiting futures margin requirements. Another thing. All of our indications exploit something neat on the Globex futures trader. Not technicals. We go very next level with the mechanical construct of the Globex itself. All the little autopilots, from velocity logic to the IOP, which is that. All of these things, maybe somebody's never heard of it before, but used to pilots, no, not offending any pilots here, would fly an airplane with all kinds of metrics and things they would study, they would change, they'd adjust. And right now you push a button that the computer does it all for you. And that autopilot has a lot of mechanical things that do slight tweaks and adjustments to the plane to keep it stable. And the Globex is the same thing. It's an airplane with an autopilot, with tons of them. And CME's patented all those things. It actually puts videos on their own website that teaches you how they work. Surprising that nobody before ever built a tool set exploiting the autopilot features. If the plane steers this much, there's a rule that says they'll steer it back. Literally, and they give you a video on how we do that. It's forced market action. And then there's other things that happen, right? So it's kind of neat that we're kind of the first to start creating retail indications off of physical existences of the auto systems. Okay. It's pretty neat. And each one of our techniques goes over how those work. Now, this is the gap fill on the S&P from back in the day. So let me go ahead and I think that's what that is. Let me delete that to clean the charts up. So we'll show you, like, today's a rational day. In an irrational day, there's no trades. And clearly I didn't chase the long, not chasing the short. Market is exactly nowhere, and it's very predictable. As a matter of fact, when we teach you guys how to do this, it's almost like before the market starts, everybody here is very knowledgeable of that particular thing. And right at like 15 minutes from market, irrational open, irrational summary. You can click this button and learn more about what that is. Day trading will be hard to pin. Liquidity maps and DD turn off. Resilience will not likely lead the market. And as you see, resilience nice and choppy, not leading the market. I'm not making the trades off the liquidity map. I'm doing anything. And so we're just teaching today. So the control that comes with the way I trade is very important. I'm sure some people chase the long, right? I'm sure some people chase the short, and the market's likely going to stay put. It's predictably unpredictable, as Mark said. I love that saying. I'm going to use that from now on. Okay, so I'm going to eyeball both of these together. Now, it is back inside of rational territory because we're above the green line. But in my seller trading, if I break it once, I don't jump back in. Everybody here, if you want that discretion, you can consider these things if you want. And if you do want to, you have to realize the fact that it does break one time is that trigger that says light positions, right? So anytime you break and are irrational, you should at best sit out. If you're like, well, I'm in a swing trade, what do I do? Well, you need the light position or start hedging your heavy position to make it a light position. Either way, if it's triggered once, I lighten my position in some way, shape, or form. If it triggers and stays triggered, I don't trade. If it triggers and untriggers by going back in the stable region, I lighten my position. And so should anybody. I actually lighten my position to 0. I don't do anything because I'd rather trade with a high probability win than spend 8 hours with a gamble. There's no reason to drain emotional capital when I know the market's unpredictable, right? And when I like to call yesterday, right? Yesterday was a very predictable day. The entire day was predictable, even the sell-off. Not the selling part was predictable, but the idea that the market gets random at that exact spot was predictable. So the day yesterday, which I drew at the start of the stream, you can go watch, went to a certain end point. And at the end point, I draw an X. When I draw an X, that literally is what tells people to click this X. That's what the X means. You're done. Okay. So at the X, it's done. And then right at the X is when that nasty stuff reversed and killed the market. So, you know, hypothetically, yeah, I'm safely on the sidelines. I do what I call the career trade and the hobby trade. The career trade is the part you can predict, go long and strong, get in, get out, and you're done. The thing that makes sense when markets are random, if you want to gamble, good luck. The market could do one of a million things, and I call it a day. So I don't try to predict that part. Cool. Okay. So say, for instance, liquidity map says BRSU. As we've said before, you need to put NASDAQ, and even if you are trading, because it pops back inside, you know, our rules, like I said, we can't instruct you to buy or sell. You know, futures all and equities all have trading risks. You guys have to understand everything we teach here. You should paper trade anything just to get used to it. And it takes about a week to really get acclimated to the three main tools. So now that we're back in irrational territory, I'll explain to you kind of how we'll draw a trade plan. So the first thing we do is when the market says BRSU, let me go ahead and make a few things really quick. I like to do these things right here. So, okay, and I'll talk about yesterday's stuff. I'll teach you guys a few cool tricks with Rocket Scooter. Okay, and you guys want me to do some tickers for you on the scanner, make some charts, let me know. I'll show you guys some examples. So sit out days, we like to have fun just teaching. Remember earnings next week, so be very careful. We got Netflix as I think one of the ones that is first in line. I don't know if that's today or tonight. Let me double check my earnings calendar. So every morning I have the same setup. I have what I call my pre-market checklist. Open that up. So my pre-market checklist, I always make sure I check out what's going on. Today earnings, this is Thursday, so yeah, Netflix is after hours today. I mean, it's the things go. I wouldn't consider Netflix one of the major components to really care much about anymore. I think that the Kathy Woods trade is kind of like, you know, not as potent as it used to be. So I think, you know, Netflix, and at post-COVID, I think Netflix itself is just not a good indication of a lot. I think people are going to be very choosy about what they buy going into earnings season. Okay. Everybody come on over. So the alerts for Irrational will be in the works. We contacted our contacts at our, you know, it's secret who we'll be working with, but I'm gonna let you guys know. It's probably exactly who you think it is. And if all things go well, you'll be able to see futures data in our platform probably within a month and be able to trade futures within 2. That's the first step of trading through Rocket Scooter, and then of course after we secure everything with futures, we're gonna let you guys be trading options and stocks as well Probably by summer if we can get all the things going. So yeah, take your best guess. When it comes to futures brokers. Okay, yeah, so I'll tell you about that. So this is broker level. You're gonna have futures, a whole different ball game. So you're asking the new data provider. Oh yeah, the data provider is a data provider for almost every futures broker there, every futures FCM there is. So yeah, they're the data feed will match exactly that. See, the thing is, what you're talking about, the uptime, the options data. Okay, so there are hundreds of options data providers. Matt B, am I doing trade challenge? Yeah, absolutely. No trade today. For the last 2 days, haven't made the trade. Didn't like it. So officially, when I do like put everything on the screen starting Monday, probably. I was trying to do it this week, but obviously this week is not like panning out to be like a good week to start. Like, I don't like the way the market looks. I don't like to start everything, so I'm waiting for everything to stabilize. I think next week's gonna be a better time to start. What made me shift bearish? I didn't shift bearish. Rocket Scooter tells me that it's bearish in 2 places. So when it comes to the options data, what you guys are asking, our options data providers, there's tons of them, right? And there's only a handful on the planet that can give all the data that we need to do our calculations. Oh yeah, Matt, everything will be on the screen for sure. We're building something right now for the screen for that. So it's like to make it a little prettier and nicer and easier to see. It'll all the stream will look entirely different. Trust me. I'll be doing futures trading only and likely some options trading, but not part of the challenge, just to demonstrate both. If I get a chance to really focus on that. 100%, 100%. So one of the things I'll say just in general, the options data provider that we have supplies options to other trading platforms and other tech providers. And they're one of the best there is for this kind of data, if not the best there is for the retail side. And even so, we pull so much data from them. We're like their test case, stress test case. We do something that nobody's ever done with their data feeds for Liquidity Map, because our calculations are so unique and need a certain type of data and a whole lot of it. Because we pull so much data, that's what congests the data providers. Nobody out there does anything complicated like we do with the massive like fire hose of millions of fire hoses of data that comes from Opera. To parse and roll up the data like we do with them, to get the data you guys see for Liquidity Map is like turning on a nuclear bomb for 1 second and turning it off. They weren't able to handle that. As we grew as big as we did, they clearly weren't able to handle that. So they're having to upgrade after decades of service just because of us, which is a great thing because we stress tested their data package to a degree that nobody goes. It's like if you order something from Amazon and it's like some obscure item, it's because it's in the corner of some warehouse in another city, but this guy is sitting here in some warehouse. You gotta go look and, oh, it's not here. Let's go there. Oh, there it is. Ah, okay. And we're pulling like the most obscure option and the most obscure stock in the S&P and the 500th rank stocks. So it's like we're just asking for so much of data that nobody looks at. So it's not pre-cached. And it makes a lot of sense because in a business, sense, when you're pulling data from somewhere, Amazon's not going to load up that weird, I don't know if you're ordering the weirdest thing that nobody's ever heard of. It's not readily available, right? It takes some time to obtain that. And when it comes to data and data structure, it's the same way. The fact that we need all hedge pressures calculated instantly on all stocks to do resilience, we're like waking up every single robot to search every corner instantly of, you know, and so they've had to do data improvements just to satisfy our needs, and they've done a kick-ass job of it because we haven't had any data outage in a long time. We've been working with them to update what their company's doing, and they've actually been really helpful. We've got all the way up to the highest end of the tech side. The CFO of that company comes and sits in with us all the time. COO comes and sits in all the time in those meetings. It's like, how can we improve our service? You guys found all kinds of bottlenecks, which is great because other big trading platforms weren't able to do that. And so we create improvement projects with them. And that's kind of neat to say that we're revolutionizing, you know, institutional side retail data providers, just even so with their enhancements, which makes y'all service even better. It's kind of cool. Side note. Yeah, we've been working very close with them. So the futures data provider and brokers the futures data provider serves most every FCM on the planet. Hold on one second. Daddy needed a Celsius real quick. Let's talk about the COT today as well. But back to how this works. So the first thing you're going to do is you're going to wake up, and very soon the Rocket Scooter platform will start saying rational or irrational on it. There's the indicators we have. It says markets are rational or irrational. Anytime you break through these green bands that we draw on here, I manually draw mine. This is coming once we get our futures data turned on. These things will be drawn on the charts for you. So within a month, pretty much everything we have will be automated. Up to green lines and or red lines and yellow lines, which is great. Which means Rocket Scooter Alert will come up and say irrational or rational. Irrational markets, we will physically have an auto mode that will turn off the tools that don't qualify anymore. So that's neat that the indicators anywhere that you use don't tell you don't use me right now. Your averages, your MACDs are like always on and always trying to find signals. Would it behoove you, as I tweeted today, markets are irrational, and look at resilience. It's all over the place. And it's like at this point in time, 15 minutes before market opens, just being outside a certain distance, fixed distance on the S&P futures, I can already tell that. NASDAQ as well in a similar boat. Right, the market moves so quickly, you trigger a lot of unusual hedging, which tells me things are going to be choppy. Imagine, like, since this is using real-time current price data in relationship with stocks filling their gaps, right? You can see that the market is choppy and all over the place. There's no clear direction. Resilience is a number that's either above 0 or below 0, which lets me trade through the gap. And then if you guys are paying attention this morning, one of the things that's neat is I can wake up in the morning 15 minutes before market opens, see on my screen, and say irrational open, day trading will be hard to pin, liquidity maps and DD turn off, resilience will not likely lead the market. This is one of those things that from 15 minutes for the start of the day, I can wake up and say, fuck this, I'm going back to bed. Do you use VX or VIX? You notice you use future VIX. Yeah, /VX is just a designation in some platforms that uses the slash to indicate that it's futures. VX is the official ticker of the CBOE. It's the official ticker designation. The slash, it may not be how your broker displays futures, but most of them do something with the slash. What's your take on commitment traders showing dealers net short? Dealers are always net short. Well, actually, let's talk about that in a little bit. Yeah. So in general, right, you wake up and you know what the market's going to do. It's like I can wake up and say, hey guys, your MACD and your moving average is going to be all over the place. Isn't it cool to wake up and see this and say I'm going back to bed? Everybody, if you like that idea, go ahead and toss a little like in the like comment, right? Like section. Throw some comments up. Give us some algorithm points with YouTube, because these are knowledge bombs that I take. I wake up and say no thanks, and look at that, no thanks. We've been almost like on fire the last 2 weeks every day. Haven't we seemed to just nail the way there? I'm going to sit out today, or I'm going to escape the market today. It doesn't seem like we've made any major terrible decisions, right? The power of no. A win of 0 is a win. It's not a loss. It's not you missed out. It's a win. Controlling your destiny is a win. Being in charge of your trading account is always a win. And having empowerment to not fucking do something when you shouldn't be doing something is always a win. So curious how we could have known yesterday we're going to flip bearish. You don't know it's going to flip bearish. You don't ever know. When the market is random, once a buyer and seller find each other for the first time in the tool set we give you, the market is random from there. Random. If you're trying to preemptively catch the sell-off move, you are over trading and you might as well quit trading now. Catching that sell-off yesterday was unpredictable, but you knew from the random checkpoint. You want to rewatch the stream from yesterday? The only predictable part of the market, in my opinion, was the long to that upper target. That was it. Once that upper target was achieved, it's random. And the reason it sold off is a mechanic that none of you will ever be able to see, because it sold off because monthly options are expiring, and every single time, I mentioned this yesterday, but if you didn't pay attention yesterday, then you need to write this down, because I don't want to repeat myself ever again. Everybody, I'm gonna give you 5. Everybody take 1 minute and go grab a piece of paper and a pencil, because I was very clear yesterday on these 2 facts. As a matter of fact, we talked about it on Tuesday, and I'll give you that lesson again right now. Everybody, Jay, thanks for bringing it up, bro, because I would love to teach it again. You can use the walls functionality to pick any day and time on single date and literally map out the expected volatility, okay? Where's the music at? When the small count challenge starts, everything will be on the screen. So I'm going out of there's 2 reasons why it hasn't started yet. Number 1, the market conditions were kind of meh, but also I'm going out of town, and I won't be back until the 24th, which is Tuesday. So while I do want to start, I don't want to start and then leave for 4 days and then come back and people call shenanigans. We're going for Lunar New Year to Denver. To it's a yearly tradition with the girlfriend's family, so we're gonna be leaving tomorrow, coming back Tuesday. Yeah, so 2 reasons, but yeah, I'd be trading from a laptop, and if I didn't stream for 2 days, the obscure trolls who love to watch every moment of our stream will probably call shenanigans. So no shenanigans, right? Just to be fair, I'm gonna start to finish every day. No disappearing acts, no camera tricks, no like disappearing when I'm upside down, reappearing when I'm right side up. You know what I'm saying? It's just never fair to the audience to, hey, I started a challenge, oops, I'm disappearing for 3 days. It doesn't make sense. So yeah. See, so probably like I wanted to start on Monday, but I don't know if I want to start the first 2 days on my laptop. I will probably stream those days from my laptop, but it's looking like Wednesday might be the day. Yeah. Okay. Tomorrow, volatility meeting on SPY. Yeah. So this is one thing I teach you guys all a trick right here. When you run daily mode, right? Single date on any particular date. Pick a date. I'm gonna look at next Tuesday, right? If you see that the distance between a bull zone and a bear zone is huge like this, that is expected volatility that is massive on that day. Next Tuesday, and Jay, you are paying attention, right? This is for you. Okay. Tuesday. Let me just map it out, right? Let's just have some fun with this. Let's do a monthly map, right? All right. So let me go ahead and just go to like an hour chart. And I'm just going to kind of like map out some days, right? let's pick, so we have monthly expiration on Friday, and that's exactly the mechanics we have. But I'll demonstrate next week so that you can kind of see what I'm talking about. So let's just pick month. Let's say you go to single day and auto, like auto depth, single date, and you just go through the dates one at a time. Now the monthly map feature will monthly map all of this for you. What I'm about to demonstrate manually is going to be automated sometime next week. They said the 20th, but I kicked back the redistribution zone patch, which is coming out now, and they're going to spend a little more time on it. So next Friday is going to do all this manually for you. So just saying 388 and 356 for Monday, and you're going to say, whoa, right? That's a lot. So Monday's going to be here, right? 20, 22, 23 would be here. So 388, right? And then what was it? 356. And you say, okay, so the distance between a bear zone and a bull zone, that is the expected, that you can say like expected move. So the fact that the bears and bulls are so spread apart means very volatile for that Monday. Why? And I'm just let you guess. Tell me why. Are these values still valid because of OPEX? Yeah, so Jay, you're going a step ahead, which is anything past the 20th. Take the future information with a grain of salt, because once you pass through monthly, that all changes, right? Very drastically, but don't skip ahead. Pretend that tomorrow, Friday's up monthly. This is volatility that's expected for Monday. And why? Why is Monday volatile? And let's just go through all the dates. Tuesday. And let me just, instead of drawing all these levels, let's make it very simple, right? I'm just going to say volatile if it's wide. I mean, anything greater than like 2 strikes is volatile. I mean, 1 strike is volatile. I mean, it's big. 389, 360. Yeah, Monday, volatile. Tuesday, definitely volatile, right? Wednesday, let's take a look at Wednesday. I mean, the market is certainly volatile for like day after day after day after day. Why? Earnings. It's easy, right? So when we came on the stream on Tuesday, if you guys want to go watch that. And again, this is showing how to use Rocket Scooter. Awesome tools to predict volatility in advance. So Monday, Tuesday, Wednesday, unusually volatile. But why? Well, you got Microsoft earnings, I think, on what, Tuesday, and Wednesday is like big S&P earnings day for like a bunch of companies. Yeah, of course, this is your volatility. And S&P range is massive. Look, there's for that week, we're starting to see like 300-point deviations. So the S&P is going to start rocketing around starting Monday, right? So let's get back to the beginning of the week. And this is what happened, right? Back on Monday. On Monday, we looked at Tuesday. Tuesday had a bull and bear zone right on top of each other. When I looked at it, right? So it was like, okay, Tuesday's not going to be volatile. Actually, Tuesday was here, right? So Tuesday, they were right on top of each other. We did the same map on Tuesday, and we go, oh, Tuesday's not volatile. Wednesday had like a 3-strike gap, and then Thursday had like a 3-strike gap, and then Friday got tight again. So we go, ooh, Wednesday and Thursday are going to be unusually volatile. On Tuesday, if you guys go to the Tuesday stream, I'm not lying. On Tuesday, I used Rocket Scooter to predict volatility on Wednesday and volatility on Thursday. So your first question is, how could you predict the market was going to sell off? You can't. But if I was bull to the point that I said there's the end of the day and the market's unusually volatile, well, hello, random move in either direction that's a really blast off, and let me just get out of the way. Good luck on your coin flip, though, right? But the coin flip we know is big, so you know it's volatile. And today as well, volatile as well. And we actually sold off 30-something points on the SPY, or the S&P overnight. So from Tuesday, monthly maps are telling you that volatility is going up and up. As a matter of fact, you VIX traders out there, as Rocket Scooter is showing you that the volatility is being higher and higher and higher. Should it surprise you that over the course on Tuesday, as we said Tuesday, the volatility went up on Wednesday and up on Thursday? Look at that. Ahead of that and ahead of that. And on Tuesday's stream, exactly what we said. The volatility is going to be higher. Now we roll into a new contract after VIX monthly options expired. That's part of the mechanic that caused the sell-off. Wednesday created some mechanical turbulence because VIX monthly options expired that morning. Friday, all equities options expire on their monthly expirations as well. You're just seeing expiration mechanics, which are always random. And this is the rule. I said, everybody go get a pen and paper. If you write this down, you will become a smarter trader immediately. The rule is this. Anytime the S&P is in bull structure, which means above monthly hedge pressure, leading into monthly OPEX, it means you've maintained a bullish month. Despite selling, it's still structurally bullish. The Wednesday and Thursday, I've been trading for now 13 years. I'm telling you this. The Wednesday and Thursday before monthly options expiration will always be volatile. Always. If you're in bull structure, always. So you take your day trade and get out of the way for the rest of the day. Always, always, always be volatile. And every time we lead into monthly, I teach the same lesson and people still seem to forget about it. Write this down so you don't like repeating myself. Why does that happen? Because bulls, especially in a bear market, bull structure means bullish hedging against near-term bear positions, right? It's going to be choppy. Your upward pressure and downward pressure, and there's your choppiness. Point A. So what causes the volatility? It's something you'll never be able to understand. If you have 10,000 puts that just went in the money that you bought a month ago, they're now in the money, right? What do? You have multiple options. You can A, short the stock and hold on to that short, and now you're in a position, which means who you're shorting against needs to buy from you, which means they need to go short so they can neutralize on that trade, right? The market maker. So when you exercise, you send the market maker out to the market to fish for those shares, which causes turbulence. What happens if you just want the cash, right? You want to close out the option without exercising. Well, then they just cut you a check for your victory, right? Without touching the stock market. Yeah, and that's exactly what happens, right? It's unusually volatile, and you can't predict if the winners of those options trades want the cash to get out of the way or they want the stock. What if when they bought those options in, I don't know, December, they wanted to be short, and in January, inflation data is coming down, and that was their funds mechanism to no longer be short. Then they don't want to be short anymore. Maybe in December, they're like, I'm going to take the shares. And then as January rolls around, like, I changed my mind. I want the cash. You personally cannot tell how firms will behave. So that's why, you know, when you hit one of those spots on Wednesday or Thursday in bull structure before monthly OPEX, it will be volatile. And I prove it by showing you the monthly map on Tuesday. If you go back to Tuesday's stream, we'll explain just that. It's an amazing trick because bull positions, there's always more bulls than bears in any market, no matter what, against the dealers. And remember, let's talk commitment of traders now. But the idea that the market is almost always bullish at all times, even when it's crashing, which is weird to say. A bull is somebody that wants to long the market. A bear is somebody that wants to short the market. Now, there may be more sellers than buyers, and that's what causes the market to come down. But a seller is not a bear. A seller is just a non-bull, right? What we call bull is somebody that enters a position that's long. A bear is somebody that enters a position that's short. A bear is betting on a market move down. A bull is betting on a market move up. So if you're long the market and you sell, you're not bearish, you're just a non-bull, and you're not bullish, right? So we actually have 4 designations of traders. So there's almost always more bulls than bears. It means that the people trading, more people are long than short on the market almost at all times. no matter what the environment is. If the market's crashing, it just means that that larger pool of bulls are just selling, and there's still more of them left over at the end of the day than there were people shorting against it. In very few instances, you will start to see, you know, the bears take over. But I'm about to detail what all that is. Because there's more bulls than bears, the probability of a bull structure market being volatile into monthly OPEX is very high, because volatility is just a function of the scattering of near-term options. In a 30-day window of the SPX, there's more longs and shorts. Then on the bull side of the market, you have more data points or more traders, therefore the behavior pattern can be random. If people are buying puts all over the place, way out, you know, towards the end of the month, it's not really that big of a deal. If people are scattering their options closer to now, then volatility goes up. If people are piling their options very close at the money for expiration today, people are throwing in at the money or near the money options today. The closer in time to expiration and the closer to the price is the maximization of volatility. So what yesterday that happened is that you triggered a squeeze that not only forced put sellers to short the market, but it forced longs in the index that got caught off guard to rush in and buy options, buy puts immediately. Oh shit, I forgot to buy insurance. Fuck. And we expire in 2 days, and I bought the stock and this is coming down. I need to go in and buy some puts that expire in 2 days and pay a hot premium for them and just literally put a safety net under my trade. So people jumping in to near-term, near-the-money options forces the VIX to trade even higher because it got caught off guard. So you had two mechanics yesterday, and I detail it very, 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 very detailed in yesterday's Zoom call. Market traded predictably to a level that I said after there it's random. And what we saw was we broke through like a monthly hedge pressure in QQQ, which triggered a monthly hedge pressure in SPY. So not only did QQQ lose its monthly and start squeezing people out, SPY traders were rushing in right here. And you can see with, like, if you use Black Box or something else, the unusual options flow that piled in on SPY right here, because people were having to jump in and buy 2 day to expiration monthly options because the SPYs were getting caught off guard. So at this point in time, not only did you trigger a monthly hedge break on Q, trigger a monthly hedge pressure on SPY, which forces the options sellers of those things to short SPY into the sell-off. Firms that were long the shares jump in and buy really rapid 2 days expiration monthly puts, which at this point makes VIX go up very rapidly. And let's go look at that. So you saw a very beautifully mapped out chain reaction every step of the way you could have seen. Just unusual selling as people were just getting out of the way, taking profits. It was enough to overpower the market, caused a monthly hedge pressure break. It forced market makers right here in QQQ to start selling or shorting QQQ at a rate of delta to balance those options going in the money. As the market continued to sell, SPY hit a monthly hedge pressure, and again tried to, that long pressure that comes off of that was not enough to satisfy, and then SPY option sellers to the longs that bought the puts to protect now have to short SPY on top of that to delta hedge those sold options in case they got exercised on in 2 days. And then right inside of here, where the market starts getting choppy, all the unusual options flow bots start kicking off around the world, because now you have people that long the SPY and just got caught off guard jumping in to 2 days to expiration monthly options, right? So the fact that those options expire in 2 days, VIX is a function. If you guys want to learn a little math here, I'm about to put you to sleep, but VIX is a function of basically the demand of options. I'm just going to put a D here. There's two sides to VIX, but it's a function of the demand of the option, like the price, you can say, which the demand changes the price as a function of time to expiration. So if the demand goes up, VIX goes up. If time goes down, VIX goes up. And so if you have a high demand for a short expiration schedule, VIX goes up doubly. Everyone in chat, do we understand that? This is a basic math. people want to buy a lot of options. If they buy them 30 days out, then VIX is like, okay, that's far out, whatever. But if they buy a lot of options for today's expiration, VIX is like, oh, I don't like that. VIX is a function of that. So far, so good? What's the square root of that? Anyways. But we all follow, right? So that's the storybook to answer your question. It goes for both puts and calls, right? Put and call parity will drive the Greeks to be the same on both sides of the equation when you really do the math. It goes the same for both. But the thing is that the mechanic of the stock market having more bulls than bears almost all the time. Imagine every bull is going to buy insurance. So the number of puts that the longs buy typically is almost always going to be greater than the number of calls the shorts will buy for insurance purposes. The insurance are people that want to take risk off the table. Therefore, this subset of options, market makers will drive the risk to zero. And that's what we do exploit at RocketSkewer, this drive to zero process. So the idea that there's a bigger pot of puts, when longs are getting squeezed, you have more options. So the chance of them being scattered, you know, you have more data points. The call side, you have fewer people hedged, right? So the resistances are thin and wiry on the call side. They're not thick and robust on the put side. So that's why short squeezes are massive ramp ups, because there's not a lot of resistance to that. And it's so easy to squeeze a handful of calls. It's a lot harder to squeeze a handful of puts, a bigger handful of puts, right? So that's the whole point of what happened yesterday. Just random selling triggered a squeeze in QQQ, which triggered a squeeze in SPY. And then the third part, the third act of the play was everybody rushed in and started buying these near-term expiring monthly options right around here, which again caused the market to be tumultuous, crazy, as everyone's balancing their shit rapidly at about, let's start looking at about 11:50 in the morning. Let's go to that VIX. So that would be 10:50 here. So RocketSkewer is in Eastern, this is in Central. So right about here, right? While the VIX moved and was like nice and stable for a little tiny bit, it started rapidly moving around, very rapidly, as people again started piling in randomly to options all over the place. This unusual volume, hills, up, down, up, down, up, down, shows that choppiness and random entry of options. You go look at the unusual order flow bots that are just like bing, 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 dark pool, bing, 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 unusual, bing, 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 just going all off because everybody is jumping into options right here, just because the market moved very violently, right? So the point that I'm saying is, on Tuesday, we can use RocketSkewer to predict unusual volatility here and here from that simple trick I showed you. And that's one of the things we love to teach. And you can do this with any stock. Watch this. We have Microsoft next week, right? Well, and the thing with stocks is that stocks, you have options that expire on the Friday schedule for all U.S. equities. The best part about the SPY and QQQ and, well, we'll talk about SPY and QQQ first before the Russell. SPY and QQQ now have, via CBOE new mandates, as of like 2 months ago, 2 or 3 months ago, SPY and QQQ now have weekly Monday through Thursday options when they only used to have Monday and Wednesday. When you say Monday weeklies and Wednesday weeklies, that's Monday and Wednesday. Now, options have always had weeklies, which always mean Friday. So SPY and QQQ have always had weeklies and then Monday and Wednesday weeklies. So you had a Monday, Wednesday, Friday schedule for SPY. The CBOE, for a period of 2 weeks out, now issue Tuesday and Thursday options for weeklies for SPY and QQQ, which means you have granularity, which means you can zoom in and see that risk on SPY on a daily basis. You can map out SPY day after day after day after day right now like you do. And I made a tweet and I said, RocketSkewer just got twice as strong. Just you wait. And everyone knew what the fuck I was talking about, because those monthly volatility targets can predict volatility now, not using Monday and Wednesday and Friday options, but every single day I can see volatility days in advance before it happens. So that's exactly why I made that tweet. And I said, rockets here just got twice as strong. And you guys have no idea. I think it was Mel Stone from Black Box messaged me and was like, I think I know where you're going with this, and I'm super excited. Predicting volatility is a key to getting ahead of the market. And Tuesday, who remembers on Tuesday that I said Wednesday and Thursday will be unusually volatile? Y'all here on Tuesday? The entire lesson of that stream was about that, right? Because I have Tuesday expiring options and Wednesday expiring options as well. So the idea that we can look at every single day for 2 weeks out on the S&P is marvelous, right? So I'm going to go in here on the SPY and look at a single date today, right? Let's go to today and let's pick the date. And I'm going to go in here and say today's the 19th. Look at today, right? By my rules, would you say that today's morning is going to be volatile or not? And I'll answer your question, Corey, right now. I invite everybody to check out the Rocket Scooter platform. We have a free trial for 7 days. The tools and indications that we give you are trying to always, always, always add to your toolbox tools that do not use technical analysis and instead correct the idea that you're using past price action to predict future pivots. We use market maker options. We use order flow imbalances, or sorry, order imbalances. We use market maker options in the future to predict volatility. We use all kinds of new techniques and tools off of a data set that you didn't know existed. So far so good. Alan is hitting it pretty good. Price change relative to put or call density, squeeze potential. How does VIX weigh in differentiate the selling vs selling versus the buying of an option, all things being equal? How does the VIX weight or differentiate the selling versus the buying of options? So the you're gonna make me get out the white paper. So it has to do with the pricing of the options. So there's a thickness. Oh, well, Alan is actually saying it right now. A thickness or a density that you're fighting against. So the example is you're missing a very important piece of your question, which is if I'm buying against a density like that and buying against a density like that, I'm going to have a different effect on the price. The price may go up that much against my buying. The price may go up that much for that call or put against my buying. This is the ask price in two different cases. So as Alan is mentioning, the density will affect the price change if the demand is equal. If I want to buy 1 million of some put at the ask, here I'm buying against a bigger willing seller than a smaller willing seller. So this I'll probably clear out the tier and jump to the next price and next price, right? So it's in the assessment or the understanding you have to make is you're trading against the market, and it's how much demand changes the price of near-term options near the money is what VIX in a single elevator pitch sentence is. So again, VIX is how much you can change the price of one index level lower or higher. There's a whole equation that tells you what the forward index is. It's how much you can change the price of those options containing the near the money. So the forward index level, it's an equation. It tells you what those are, but it's just for sake of argument, assume it's the next call and the next put on both sides. So the box that's immediately surrounding the option, it's how well you're able to change the price of those options over the 30-day window. So the thicker this wall is, the harder it is to change that price. If the thickness of this wall takes place here with the same thickness, VIX will have less of an impact. The thicker wall is less price change, less VIX. If that thicker wall moves here, the VIX will lower. If that thicker wall moves here, the VIX will lower, less strict. if this wall right here becomes thinner, VIX will go up. If this wall here becomes thinner, VIX will go up less. So it's again, it's the easiest way to think of it is if you were to draw a box around the VIX, it goes to monthly. You have options, right, that expire all throughout that month. Remember, it's looking at SPX options over the 30-day window, so all options. So people start padding the SPX 3 weeks out, right here and right here. It's going to be less volatile the tighter you are putting a box around it, right? There's more buffer to market. So the idea is it's like how thick the wall is and how close to now those options expire. So the idea is if you're able to change the price of options here and here very rapidly, because people are buying puts all over the place for tomorrow's expiration, this is a very, very thin wall. Right now, we expire tomorrow. This is where the VIX goes way up. People are just spontaneously jumping into random out-of-the-money puts with a high spread. When you have a high spread of out-of-the-money puts, what happens, John? You know that. Like if I wanted to right now, oh shit, I need to buy some 387 puts right now. There's a massive spread on that, and I'm gonna pummel the ask, which is going to really raise the price of these options that nobody's buying. So if I'm buying illiquid out of the money options for today's expiration, that VIX is going to walk straight up, right? So, but if everybody comes in and says, oh crap, I need to buy options right now, I'm going to buy them here, I'm going to buy them here, buy them here, buy them here, and everybody's just building a very thick wall right here, volatility will go up, but it won't go up a lot because the options are near the money. The demand is right here where the bid ask is really small. And that market, I guess that thickness is smaller as well. This is a volatility lesson. This is dissecting what the VIX actually is. Pretty neat, right? So people are containing the market and buying a lot of options here and a lot of options here that expire today, for instance. And that VIX is likely going to go up because the demand is going up, but it's going to go up just a teeny weeny little bit. And that's what's happening today. And you can see that that's what's happening today. So the more spread out options are, the closer to expiration that spreading out is, then the higher the VIX goes. And a rule of thumb at Rocket Shooter is very simple. It's when the S&P is in bull structure, above monthly hedge pressure. 2 days for expiration, Wednesday and Thursday, but unusually volatile. And you can confirm that with the walls widget, right? And we're going to have this all automated for you guys, which actually show this on the chart and make it fun. Okay, so is today going to be unusually volatile by our rules? Bulls and bears are right next to each other today for the 19th. Y'all see that? Today's not going to be unusually volatile at all, or it's not expected to be. So if I were to jump in and say, oh, it's going to be a nice flat day and irrational at the same time, I'm not expecting the markets to squeeze up or crash lower because it's a nice tight market. So another reason for me to say there's not a lot of movement. Even though irrational has me want to trade small below the screen line, this is telling me the SPY is going to move up and down in burps of 10 points. Do we all understand that? So when I showed you that monthly map for like Monday, Tuesday, and Wednesday, you've got hundreds of points of gap in the S&P between bulls and bears, which means unusually volatile. So the markets on Tuesday, we said Wednesday was going to be volatile, Thursday was going to be volatile, and Wednesday and Thursday are going to be volatile. Ahead of time. And now once that volatility was realized, we come to Thursday and Thursday's tight again. Let's look at Friday. Let's see what tomorrow looks like. Slightly more volatile tomorrow based on what happened yesterday, right? This is based on yesterday's close. And we wake up today and this is what everyone's risk is spread out. So tomorrow is more volatile than today. Everyone type a big fat yes in chat if you follow and understand this particular concept. And push like and stream if you're learning something today. Every time we sit out, I try to teach something very advanced to the group or something different than just what's in their simple videos. Rocket Scooter has a free trial. I urge everybody to go check it out. The tools we give you, you will not be disappointed in learning some of them. Those new folks that are here, everybody understand? So if I were to say, I had to make like an Excel spreadsheet and I just say like volatility, right? This is the minimal when bulls and bears are right on top of each other. So let's do like today, right? Thursday. It's mild. It's minimum. Today's minimum volatility. If I were to go here and go to the 20th, I'm just going to write the numbers. So min, I'll say it was 10, right? Friday, from today's perspective, is 20. Is tomorrow more or less volatile than today? Remember, volatility is how far away bulls and bears are from each other. In the greatest sense of volatility, the idea that people's disagreement of the market is higher, then it means people's options to protect those positions are going to be more spread out, which means volatility is going to go up. If I'm a bull at 382 and you're a bear at 381, then our options are likely to be more compact than if the bulls and bears are spread out, right? This is the position and this is the options. Position, options, then position, then the options will be more spread out. The more spread out the bulls and bears are, right? So the idea that just the distance between the zones indicates higher volatility from one day to the next. Anything that's not on top of each other, you start to assume what's going to cause a SPY to move 20 points. And I'm going to give you guys an advanced lesson. What will we consider irrational or unusual in the SPY that would trigger? This would tell me, okay, tomorrow is more volatile than today. It's 20. More volatility, right? Resilience and white and zero. Ooh, let me talk about that in 2 minutes as soon as I finish. That's a great question, futures. Resilience is your scalping tool for futures, and that's what it was designed for originally. So question, right? If the distance between bulls and bears was 10 and tomorrow it's 20, volatility is going up, right? But I want to know if you guys can take a really wild guess. This crazy no copyright EDM music is all freaking Skrillex this morning. Like, I'm just like, okay, I'm over that. Let's go back to the softer part of that playlist. If you guys learned anything today, what is a distance that would scare you? And I'm literally hinting at it with my mouse. What distance here that you would project in the future would scare you out of trading that day? Can y'all take a guess? Yeah, about 3 points or more. Yeah. Wouldn't it behoove you that ties together with this? Aha. Now it's like those brain explosions are going off, right? When I release the monthly map series of videos, it'll be that glue that you've always wanted to tie everything together. It will be the most comprehensive lesson on futures, options, and stocks that pull everything full circle. We've been waiting for months to release this, to get it made and release videos that will really just blow everything that we make, blow everybody's brains on everything we make, and glue it all together. Is it all starting to like goosebumps on your arms to be like, holy shit, that makes perfect sense? Can you predict an irrational day in the future? You absolutely can. Not only did we wake up every morning and go, oh, it's irrational today, but do you remember the lesson on Tuesday when I said very high volatility on Wednesday and Thursday? Wednesday was like a 3-point distance, and Thursday was a 2-point distance, right? None of them are greater than 30 points. And lo and behold, none of them spanned that band too far. So if you can understand that if that distance is 4, 5, or 6 strikes, you're almost forecasting an irrational day in the future based on today's options at that point in time. So now let's go back to Rocket Scooter. I know you guys, let me give you a moment for your goosebumps to settle. But today is a 20-point volatility, right? For tomorrow. The market tends to price in today's action and tomorrow's action simultaneously. And I don't know if it will kind of like, again, give you that, oh my God, feeling. At least to note that if I were to make this box a distance of 20 points, I don't know if that's really making you understand something that you never have seen before on these pivots. Hold on, let me pick the mic up off the floor because I just dropped it. There's your 20 points. There it is. There it is. All right. So what you're actually looking at is today's expiration and tomorrow's forecast simultaneously at the same time. And again, this is telling me that going into tomorrow, I'm expecting a little bit of 20 points of variance in price moves. So my pivots are going to go up and down 20 points and find natural support and resistance just from those deltas being matched. It circles all the way back to options. So this box is a distance of that distance. And it's just showing you the market is moving in burps of that much. Look at this wick and wick, exactly 20 points. 20 points tomorrow. So imagine this, right? Let's look at Microsoft earnings day. 389, 360. Okay, so number one, and this is another rule you have to understand, is that your visibility of this, as cool as this is, never try to forecast beyond monthly expiration. And don't wake up and say, holy crap, 389 and 360, ooh, 290 points on the S&P? That's crazy. Well, yes, but after monthly, the very next Monday, this will drastically change. Your visibility and the monthly maps trick ends at the month. So all month, I'm only going to look at everything up to that point, no matter what day I'm at. We all understand? On the 23rd, boy, oh boy, I've got a whole month of data to look at. And every single day, I can look at every option inside of that month. Does that make sense? Okay, we'll talk about some swing plays. So the neat thing is that while it does point at unusual volatility now because of people getting ahead of, Microsoft earnings, pretend that tomorrow wasn't monthly expiration and it was just another day in a month. I would look at this and I would say, holy crap, this day is very volatile. Why? What the hell is going on that day? Now, I don't tell myself that's the expected move beyond the 20th, but the very next Monday we come back, these will be correctly expected moves. It's the mechanics of how firms roll from one month to the next. So just trust me on that. Your prediction of how much this little box is, this I blew your mind box, you can only forecast up to monthly expiration. So it's very strong that very following Monday. So this Monday, we have a very clear direction of the volatility of the market and direction of the market. Committed traders, somebody asked that. Let's go. So I would say, okay, I would just normally naturally say what's going on the 24th. I'd first go to earnings calendar and say, oh yeah, that's the start of major tech earnings, right? Of $1 trillion company. Is it trillion? It's a million. No, I'm sorry, these are thousands. Yeah. That trillion? That's a trillion, right? And next day, Tesla. Ooh, big. Or is that billion? That's trillion. That's the market cap. Earnings, right? Boom. So the idea is that you know something's up, and this is the answer. But I'm giving it to you. Committed traders to talk about it. Somebody asked. Let's go. Okay, easiest way to understand the committed traders. I want everybody to do me a favor. Try out the Rocket Scooter free trial really quick and go to the Discord. I'm gonna give you 2 links. We're gonna do a very awesome Zoom call today that's gonna be even cooler. Than what we're going over today. Our Discord is currently free. As of February 1st, you will no longer be able to access our Discord without a paying membership, no matter what. You have to be a Rocket Scooter subscriber. To get access to any of the channels starting February 1st. But I will let you know a little hint, a little teaser. No, I don't have any swing positions at the moment. My portfolios are all fully cash. Because in this particular sense, I said the market's going to be flat going into earnings. And when I said that back in December, that's completely right. And I don't want to swing through earnings. It's going to be a variable. All the market's telling me is that it's going to be volatile and choppy. And all data is showing that the economy's flat. Growth is flat. Wages are coming down, inflation's coming down, FOMC still raising rates. So the market is not bearish, not bullish, slightly bullish-ish data, but still FOMC rate hikes and lower margins in stocks. So the stock market's gonna get some weak earnings data across the board. It's getting some strong inflation coming down data from wages coming down. So it's mildly up, mildly down, and very volatile. So it means the market volatility is coming from the thinness or lack of participants. So going to earnings, I'm assuming that the market's going to start become choppier and flat for about a month. So there's no reason to swing this. If you're swinging this, you need to learn how the fundamentals of the market are going to be dictated by earnings and changes. Now we've seen, I'll talk about all the data points that's flattening out the economy right now. There's no evidence that the market's going anywhere. This is not the time for me to believe to start loading up on any longs or shorts for myself. Fully cash. Okay, so come in with traders really quick. Godfather, to answer your question quickly, when market mechanism pushes back from irrational to rational, can you exploit it? Yes. But the difference is that if you trigger it once, your brain triggers for the rest of the day that your position size needs to be small if you do trade. Indicators will turn on above here and turn off below here. If they trigger at least once, imagine that it flags like a yellow caution for the rest of the day. So example, to just answer your question, I'll go back to some of the other ones. So imagine that the market triggers once overnight. All day long, you'd have like, just kind of like an alert that says caution. So from this point in time, while it is rational, you can exploit it, but the caution says small position. Like I'm talking like 1/10 of the risk. So again, small baby scalps if you are trading, because the first trigger indicates the market's going to behave a little weird. So they're on, they're off. It's like on here, off here. So if you do want to play the rational, irrational side, if you trigger just one time, you're automatically doing small positions. If you're currently here, you're doing 0 position. That's the way I treat it. Yeah. Okay. So what mechanism pushes the market? Oh, what mechanism? Oh, it's random. You don't know. Markets don't want to break these hedging barriers. And when they do, it's rapid shorting by market makers who are at the boundary of their risk of the futures of this index. So they're rapidly acquiring shorts, and it just comes down to in this territory how many people are willing to buy here. And so it's all going to be random because you don't know who's going to buy. New longs, shorts covering. It just becomes very chaotic and choppy down here. So the mechanism is something that nobody can see because it's based on people's risk, people's exposure. Can they handle that drawdown? Are they getting margin calls? Is a big firm getting a margin call, or hundreds of small firms getting margin calls, or shorts covering for profit? It becomes very random as to the mechanism. Sorry, yes for the mechanism, my bad. Does that make sense? The market is structured. You just expect nobody to be changing much. So we all exploit just the algorithmic portion of order matching. That's why we look at that when it's rational. When markets are irrational, humans start to step in and behave a little funkily because they're getting margin calls and weird stuff. And how do you know? It was random volume spikes just out of the blue that come out of nowhere. Imagine each one of these volume spikes could be a margin call, right? Just a rapid exiting of a position. So firm A, firm B, massive firm C, 20 firms D, right? You don't know. So what's the mechanism that can push it back in? Is the only mechanism that moves the market is that the buyers overwhelm the sellers. That's it. So inside of here, your guess is as good as mine, because while buyers and sellers naturally are going to be hard to forecast, a BRSU is going to tell me where buyers and sellers are likely going to be, right? So let's go to the liquidity map and just kind of teach you this lesson with. It's a great question though. In the BRSU, what happens when you break through hedge pressure? It likely collapses to the next resistance. So we need to find where that resistance is. Where are we going to find some buyers? Let's go find them, right? But also knowing that in the middle of this irrational market, while we may find buyers anywhere where that resistance is, you're still going to have like likely margin calls. Longs just dumping their position against it. So if a big firm dumps, you're not going to know how big that is against the buyers. So in the irrational side, the only way that moves markets higher is that this buyers just naturally overwhelm the sellers against all this meteor strike falling, pew, 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 big explosions everywhere. So let's just go naturally find the next resistance just to see if we can't find one. First thing we always like to do is like look for gaps, right? Doesn't seem to be one except for like way down here. So there is nothing inside of here that could indicate any kind of resistance. Let's look at the monthly expiration. 382 is the bottom of bull territory. So there's your resistance, right? So my brain tells me I've got buyers for monthly expiration all the way down to 382 is the side of the bull side. So I tell myself, holy crap, if this falls, I don't have any evidence that there's buyers. I always use this as my measurement of worst case scenario. We don't bet that you break through monthly bear territory, and that's also a trick we have here. This is monthly bear for monthly. You always look at monthly when you want to find bigger resistances. So if I were to categorize like my long, how far can it go against me over 2 days? 5 more points. So bulls can appear anywhere in here randomly because clearly there are bulls already there. But the problem is that the market is falling. What happens is this 385 person decides to get out of their position. This 383 person gets out of their position. This 382, the market could continue to collapse. So you don't know which one of these guys are going to hang on to their position. And it also doesn't guarantee that new bulls will step in there. Just prove that there were bulls there before. So ideally, the way we look at it is that I tell myself, what mechanism can push it rationally? You need bulls to step back in. While the daily option or the weekly options don't have any evidence of bulls being here in the short term, we do have these monthlies parked there, bulls being there over the course of the month. And the question is, this means they were there yesterday afternoon and this morning. So this is the end of the day's report yesterday. So it means this morning, there are still bulls here for tomorrow. All the way down 382. So your guess is as good as mine as to where bulls will step in for today to push it back in. Amidst all the margin calls that happen below the green, bulls can be anywhere. Here, 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 and here. So because they could be anywhere and it's such a large distance, I have no desire to trade on these breaks. Because the reversal could be at a random spot anywhere, and betting on where that would be just seems like a fool's errand, right? So the mechanism is what pushes it back in. Is you just need the bulls to step in, or bulls to step in somewhere, or shorts to cover. But you need buyers to overwhelm sellers. Okay, so back to COT, because this is the last thing we're talking about before I get out of here. We're gonna go to the Discord. Everybody click that Discord, go there now. Get access to the free trial, and we have a Zoom call that goes, there's some really cool stuff. We'll teach lessons on Rocket Scooter today. This is just a general thing. So Commitment Trader is very easy to analyze. I'll go over this fully in that Zoom call, but we're going to talk about what's going on now. Okay. You have walls for... Walls are derived from equities options. That is the secret sauce. We don't derive walls from SPX or ES. Even if we could, we wouldn't do it because they wouldn't be as accurate as the index ETF. The trick is that the options of SPY settle in shares of SPY, which forces the market makers of those options to circle back and buy those shares. You buy the shares, market maker buys an option to protect, which makes the option seller buy the shares. So that loop closes back on itself. That's what makes the magic of liquidity maps happen. All order flow is contained within shares of SPY. In futures, S&P futures settle in cash. Or actually, sorry, shares, sorry, S&P futures settle, futures options, sorry, futures settle in cash, futures options settle in futures contracts. So if I buy a futures contract and somebody shorted a futures contract and bought a futures option, then the option seller can settle in that contract or settle in cash. The idea that cash escapes the loop means that you don't consider it for liquidity map. And even worse, SPX has no shares, period. So SPX options settle only in cash. So SPX fully escapes the loop into cash. So while futures has some of it circled back as the futures options exercise, now they're European style, which means they exercise, or they can only exercise on expiration day. So you know that day is coming, but settling in cash means you lose some of the visibility of that discretion traders will have. Godfather, do you understand? I explain this all the time, and it's one of our videos as well. SPX is purely, options are purely cash settled. So you can't buy SPX shares. Everything goes to cash. So there is no, like if I buy SPX, market makers aren't coming back in buying SPX from me. This doesn't exist. So the idea that SPX doesn't circle back in shares of itself means that there is no strength and a liquidity map on SPX. But since SPY and ES and SPX all track each other, and if they don't, arbitrage trading will pull them all back together like a giant magnet. You take the strongest loop back. Now again, some SPY options can settle in cash as well. Just keep in mind. But the observation is that the idea that you can settle back into that particular share of that basket will also force other people to buy stocks in that basket, which strengthens the loop as well. So the idea is that everything loops back to stocks here. This loops back to an instrument that settles in cash. This settles only in cash. The options here settle in futures contracts, which you can choose to grab the futures contract, which settles in cash, or you can choose to grab the cash immediately without the contract by exercising the option for cash. Either way, all of futures turn to cash. All of SPX turns to cash. The options, futures options will ultimately turn to cash when the options and the futures contracts settle. SPX will always turn to cash when those options expire. SPY will, majority of that will turn into shares of SPY, which turns into shares of stock. Most people will buy options to obtain or hedge their share positions, forcing market makers to buy those shares. The other two examples force market makers just to go out and borrow cash if they don't got it. So if you want a liquidity map for SPX or ES, it's very simple. You take these levels and you convert them to SPX or ES, and they will pivot at exactly the same spot. So back to the commitment of traders. Is volatility measured by the distance between call and put wall, or the distance in the put and call wall also an indication? So Michael, in general, volatility only measured by the distance between call and put wall. It's an indication of market maker distribution. So if market makers are bullish, or market makers are long calls here in majority and long puts here in majority, and like one sweep, like it's all, the majority is all calls, right? From 382. The majority is all puts. This distance shows the clear split between where bulls and bears are on the market side. So this is the measurement of people's disagreement between where the market's bullish and bearish. As the entire bulk of bulls, all the bulls are standing in line above 382, all the bears sitting in line below 380. The bigger this distance, the more spread out bulls and bears are from each other. In a general sense, is a higher volatility. I can answer your question. So next thing, commitment of traders, the last part, simplest thing to understand. When you really do it right, what you do is you look at, I look at, and people look at it differently. When the green line and blue line are pinching or pulling away from each other, markets are liquid. This is liquid with people exiting positions. And y'all want to write this down real quick. This is liquid with people entering positions. So liquid means sellers and buyers are finding each other, but they're exiting. Longs are selling because this is your long asset managers and this is shorts covering. These are your short hedge funds. So exiting means the number of traders, right, from A to B is getting smaller. Let's call this like number of traders, right? Fewer people trading the market, which means the liquidity gain from this is also becoming less liquid over time from the lack of traders. So it's like, while the market is somewhat liquid, it's threatening future illiquidity because of fewer participants. This is people entering trades. Longs going more long, shorts going more shorts. The number of traders is increasing. This is the best kind of liquidity. It's a double liquid. So they're fanning away from each other. That's the most stability in the market. Very easy to see that. So at particular points when the green's going up and the blue's going down, markets from here to here are surprisingly liquid. And the rule of thumb is liquid markets do not crash. Do not crash. And they never have and never will. And they never have before. Liquid markets on the double LL do not crash. You're learning so much today. Here's another time when they fan out. Liquid markets do not crash. Here's a time when they're fanning out. Liquid markets do not crash. This is like, if you got any brainlet that's not been blown out of your skull from your mind being blown today, of all these relationships, this is what we do here. And I love teaching people stuff. So again, right here, it's compressing, right? Sellers and buyers are meeting each other. It's still liquid, but threatens future illiquidity as people are exiting positions. So from here to here, it's not crashing, but that kind of liquidity gain that does not crash is met by future illiquidity. And the relationship is liquidity is the inverse of volatility. So as people are leaving, remember we talked about earlier, fewer traders means more spread out options, likely, thinner resistances. So the less liquid from fewer traders, the higher volatility. And lo and behold, here's the proof of that. Everything has mathematical reasoning in the stock market. So here is your liquid markets don't crash. And here is your normal volatility. And here's your amplified volatility from traders exiting their longs and exiting shorts. Fewer traders being part of the market during quantitative tightening's announcement. Isn't that pretty cool, right? So Commitment of Traders is the best storybook you'll ever be able to tell, that while liquid markets don't crash, both compressing, pinching and pulling, it doesn't crash. And so up to this point, pulling away from each other, it doesn't crash. Pinching doesn't crash, but the pinching aspect has volatility goes up and the pulling aspect has volatility go down. So volatility being the distance of oscillations, there's a measure of one volatility range. And here's a measure of another. This is clearly higher volatility than this choppy month and this choppy month. They're very small relative to this one. The tightening of ranges is that lowering of volatility as this behavior goes further into the future. Pretty cool, right? So it's neat how everything all ties back into. Now here's the part when they're both pointing in the same direction. If there are longs exiting their trade and shorts entering their trade, you have two sellers to the market. Everyone's selling to the market when they point in the same direction. Anytime they point in the same direction, illiquid. And it's the same thing as before. You do the same relationship. Illiquid, illiquid. So in this relationship, longs are exiting. In this relationship, shorts are becoming more short. More people are entering. So for every long that exits, short enters, the number of participants, number of traders is the same. Same. If they're parallel. So you're not gaining or losing traders. You have more people shorting than people were longing. As a matter of fact, you can almost view this as the long flip short. It's just capitulation. Think of it like that. Number of traders is the same and people are switching teams. Bulls are becoming bears. Bears enter positions. Longs are exiting. Shorts are gaining. So it's a man-for-man switch if they're perfectly parallel. Pretty cool, right? So when they're both pointing up, longs are entering. It's the same thing in reverse. Shorts are exiting. Shorts are covering. Man-for-man switch. Number of traders is the same. Capitulation. So anytime they're parallel, people are jumping ship with this relationship. So let's find a place where they're clearly parallel over a course. And this report's spent out once a week from here to here. Capitulation to the downside from here. Actually, let's go back to where it was about here. Yeah, to about here. Capitulation to the downside. You remember when the market felt the most violent during the bear market? Pure downside capitulation. And from this point in time here, they start to, longs are going more long, shorts are going more short. People are entering the market again. And it's liquid. Liquid markets do not crash, and it has not crashed since liquidity came back to the market. Now, the scary thing is that here, give me the answer, and I'm going to call the stream that there. What about this community of traders is fucking terrifying right now that you see, based on what you see on my screen to the right? Now, this is exiting. This doesn't say exiting, S-E-X. Somebody DM'd me and said, why does it say sex on your screen? Shorts exiting, longs entering. There you go. So tell me what you see and just draw it yourself. Or look at my screen, give me the answer, and as soon as somebody gives me the answer, I'm done. As of this point in time, something is scaring me as of this moment in time on this stock market. No, tell me the picture. Match it to something on the right of the screen. Just use the, well, not talking about the market makers yet. Skip that part. Just look purely between the long side of the market and the short side of the market, ignoring the reportables and dealers now. Just look at that basic relationship. Tell me what's happening to green and tell me what's happening to blue. Parallel down, okay? So in a storybook, as of this point in time, longs are exiting, number one, and shorts are entering. Do we all see this right here? Longs exiting, shorts entering. No, Itai, you're incorrect. You can't derive... yes, people are not buying. People are selling faster than they're buying. But people... The second part of what you said, right? There are more people shorting than covering. So second part, people are selling faster than they're buying to enter a position. People are shorting faster than they're covering to exit. So in this particular sense, you got half of it, right? Longs are dumping and shorts are entering. Yes, so you have longs are exiting their position and shorts are entering. It's called capitulation. You have bulls becoming bears. And the number of traders is the same, which means no new money is coming into the market. And money's not exiting the market either. So the market is maintaining a constant volatility as one side flips to the other, which is okay. We'll talk about the volatility in a second when it comes to the dealer side of things. But in general, the market's going to maintain a similar volatility over the course of this period of time because the number of traders are the same. The thickness will probably be the same. People just jump from one side to the other. And again, if people are long with puts, they turn to short with calls. They're probably going to have the same risk profile. And therefore, the market's going to be volatile. No. The market's going to be liquid. No. Well, wait. How can that be? Well, think about this. Volatility has two faces, right? It's time and price. Now, while you have longs exiting and shorts entering, the number of traders are the same. So ideally, we're purely trading on fundamentals at this point, and you can't. People are getting out of their long and going to short because of fundamental reasons. When they're parallel, we say the market is illiquid, which means volatility should go up. But also the idea that there's the same amount of traders kind of has like a neutralizing effect to that volatility going up. If traders are just purely flipping, because you don't know if everybody's flipping sides, or one trader may exit and a new trader may enter as a different person. So that higher volatility from this is kind of like neutralized a little bit by this effect. So the idea that we've seen a tightening of the market is why we're seeing a consolidation in the market. This is pure capitulation from bulls to bears, with roughly the same number of traders if they're parallel to each other. Now let's really, I've been trying to yell or scream that to hint to see if somebody caught the part I almost accidentally skipped ahead. I kind of stumbled on my words a little bit because I skipped ahead. What part of this chart scares the fuck out of me, and I'm drawing it before your very eyes? Please tell me that answer, because they are not parallel. Now tell me the real answer, and you're on the right page. Nom 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 one. Now tell me what you see. And now I'll talk about the stock market, and we're gonna call it a day. Talk about the slope of those two lines. Which one looks worse than the other? Shorts are entering faster than longs are selling. So that tells you what? The number of traders is going up. It's not the same. It's not one for one. One for one would be like that. That's capitulation. Pure switch from one side to the other is capitulation plus new bears. This is like mind blown. The sharper the shorts are climbing into the market, it means new bears. It means cash from the sideline is entering the market bearish, while bulls are switching to be bearish. This is double whammy for the bear side. It means that parked cash is now bearish. Crazy. Y'all liking this? Pretty cool. So it means new bears are entering the market as early as that particular spot. So market is now from here becoming more volatile. and becoming more bearish since, let's find out what day that is. Let's go all the way back to the 19th of December. Ready? When that pivot took place. And we're going to call it a day. Let's see what Rock Scooter says about the 19th of December. Let's get nice and big here. And let's just go, this is QQQ, but let's go ahead and just talk about the SPY. What happened the 19th of December? And we'll call it a day. Go to the Discord. We'll have a nice little lesson going forward. As the number of traders have been stepping through in the 19th of December, that nice stable market is becoming more volatile. As indicated by the commitment of traders. We all just showed that, right? You have bears outpacing the bulls. Remember that relationship? Let me just put that back on the screen. Okay, new bears. We're going to talk about the market maker's side now. So the volatility is being increased by a one-sided tilt to the bear side of the market. So this nice consolidating range, this volatility was going down. From the 19th of December, the new bears started stepping in, which ultimately started widening that volatility. The candles are getting bigger. Tight candles, big sells, big longs, right? The new bears are creating a tilt to the market that are inducing volatility. And you can see that in two places. One of the easiest places to see that is the contango that was built into the volatility futures. That projected future volatility was built into futures as we built a lot of contango and continue to rally on that VIX contract. So market is pricing in that additional volatility. Everything loops back to itself. Number two is let's bring up the dealers, okay? Candles are getting bigger and wider. And why are these new bears stepping in? And I want somebody to tell me the storybook and then we'll call it a day. Why are there new bears? What are they being bearish on? What's coming up? New bears on earnings. The only thing I can see coming forward. The green line is slightly flat or negative. Either way, it's the same. Flat, slightly negative, or even up. The idea that there's more bears entering than there are bulls entering again tilts the market to the bear side. The storybook is people are becoming bearish as of the 19th on either earnings or Fed policy or something fundamental. The market is starting to tilt its way bearish, and we've seen a positive DD number in the short term, which is why the market's moved up. But as of today, the positional risk is now negative, and now the bear market is not only realized on the longer term, but as of today, the bear market has returned day to day. So today, the bear market is back on. Somebody asked me at the beginning of the stream why I'm bearish now. It's because the commitment of traders has been leaning bearish while we got a squeeze in the monthly. As of yesterday was the last bull DD day, right? It's like a 0.8 and now it's a 0.4. The market on the daily basis is now officially bearish again because the commitment of traders was bearish since the 19th and now positional data is bearish as of a month later. So the bear market, again, you can quote me, has returned today. We have 2 day. This could be just expiration mechanics, but as of Monday, if this doesn't change, then the bear market's back, which is scary. Let's see what the dealers have to say about that. And I'm going to, again, I seem to call it a day, but the dealers are covering as a net imbalance between all other reportable traded entities, right? So the dealers make up the deficit. If we, again, ignoring the other reportables line, it's relatively flat. Let's just look again at the relationship. This is the next best part. Longs are exiting and shorts are entering faster in the capitulation range. So the new bears have to short against somebody, right? So they need to sell to somebody. You need somebody to buy from them. There are no bulls buying from them, so who needs to buy from them? Well, that's where the market makers fill up the gap. So new bears are offset with a similar slope in the market makers. It's like almost exactly the same. I mean, you can see it right there. So the bears have to sell or short. Sorry, bears have to short against somebody. Well, who is somebody? Certainly, the idea, if you could say the green is flat-ish, it means that the red and blue are now going to be equal slope as well. Do you see that, Itai Dom? It's almost 1-for-1 market maker against shorts. And if you consider the long part of the trade, it's just kind of like, you know, it's slightly down. But again, let's just assume that being flat, let's forget that it's even there. Clearly, you have shorts trading against market makers, okay? That's what you see. And so the idea is that if the purest bet of the market right now are new bears against the market makers, now a second mechanic kicks in. That's the manipulation side of the market maker. If the current bet is the market makers are short the market on a net short, then if price goes up, then the market makers lose. And so they're not going to let price go up. But if the price goes down, the shorts are going to win. So who pays the winning short? And let's see if you guys can complete the puzzle. So the next step when you look at market makers, you try to look at what they want to do. Currently, market makers are long or less short the market, but they're still negative, right? This is the zero line. And this is the neatest part about COT. I love this kind of analysis. This is zero line. Market makers are short and so are the bears. Everyone's short. And let me tell you, market makers always like to win their trades. So if they had to choose, they could raise the price to squeeze the short, or they can drop the price and win the trade, allowing the shorts to win to squeeze out the longs. And the longs will pay both of those guys. The idea that market makers are still negative against a growing bear market. When the market makers are short against new bears, that's when I get scared of the market. Because there's a whole big fat juicy set of longs that are ready to get squeezed to pay out that winning dealer. Let's find other examples of those types of environments in here. And then I love COT is my favorite thing to look at, man. I love these things. Well, let's find some times when, here's an example right here where the dealers go up and are negative against that blue that went short, right? So essentially, blue goes down. It's like, how about this one right here, right? Let's talk about all of them. There's a blue. So this next relationship I like when you're below zero. When you have blue going down and red going up, but they're both below zero. They try to squeeze out longs. And that's where that happened. Another example. Right there. Both less than zero. New shorts, dealer longs. They like to squeeze out longs. Get ready for it, guys. Ooh. You see that relationship? Ooh. People are officially bearish today. I don't think earnings are going to come out looking good at all. Let's just tweet this. I'm officially bearish now. But I'm not shorting. So I'm just a non-bull. First bearish TD day in a while, right? In a long time. Did y'all learn something today? Hit that like button if you like it. This is my fundamental thesis. I love teaching stuff that I know, that I learn. I learn a lot of this from you guys too. Let's date this little Babe Ruth post and not say 2020. Let's forget that year ever existed. Let's go ahead and draw like a highlight around this relationship. Does everybody see this relationship? It scares me against the stock market. And I was so optimistic that we were recovering fast, and we are. Just earnings are going to come out to be shitty. Now let's draw the relationship here. It is that when more shorts I like this. New bears, market makers, both below zero. They love to squeeze longs. Longs squeeze. Longs get squeezed. So my fundamental thesis is now very strongly bearish. It's starting to tilt today. Doesn't mean it's not going to rally or the next couple of days or whatever. The longs are getting squeezed, and you can see periods of where this happens, and it is scary. Longs get squeezed, and it causes that dynamic that we can get lower lows even before my summer prediction, and I don't like that. Today, position split bearish, and the structure is certainly scary as fuck. Okay? So these relationships are very strong and very good because these are the positional data of Wall Street. Okay. I don't like this. I don't like this at all. But again, today the market is officially bearish again. Did Jim Cramer say yesterday that the market's bullish? Can I get my real confirmation? Oi. Scary. The bear market is back. I'm scared. Here's my thesis. Detailing it. Back officially today. I'm very scared of what I see. Here's my thesis. Detailing it's all in a Zoom call in 5 minutes. Join now. Urgent. Okay, let's go. All right. All right. Love you guys. Rocket Scooter, thank you for supporting our team. I love having streams. Love teaching, love learning. When I teach, I learn. I learn from y'all more than I teach y'all anything. And Rocket Scooter is a platform based on this type of analysis, positional risk. Why try to look at the shape, color, price, make your vomiting dinosaur octopus patterns blue, green, and purple? Who needs that stuff cluttering your charts and cluttering your brain and giving you retina cancer? You don't need that kind of stuff. All you need to do is see where Wall Street's positioned and let them do your homework for you. They're bullish. They probably have a good reason. They probably know better than we do. Something you don't know. Study their habits. And positional risk, to me, has been my favorite thing I've ever discovered and started working with in the markets. You start analyzing where people's positions are. You start understanding more of the behaviors of why people do what they do, more so than just trying to guess with patterns of what they did in the past. Let's look at the now. Let's not look in the past. And let's go ahead and head on over to the Rock Scooter Discord or to the link in the description of that free trial, because no credit card required in 7 days. Guys, check it out yourself. We love you. Get on over to that Discord, and we will have a session today on the COT. And I'm going to type it in. So don't go anywhere. For like 5 seconds, I'll type it in. We'll see you.